This trade stopped me out, and for a moment I questioned everything. But looking back, this was actually a good loss. My name is Vi, and I document every trade I take, wins and losses, as I work towards consistent profitability. In this video, I'll break down this live trade I took on micro Dow Jones futures, where I followed my rules, but still lost, and why I'm learning that that doesn't invalidate my strategy. First, we'll look at the higher time frame narratives, then a lower time frame entry model, and finally the lesson that this trade taught me. Let's jump into the chart. So we've turned the clock back to just before New York morning hours, and we're on the 15-minute, and we can see that we are bullish. We have a swing high, swing low, and then a higher high. And so our trading zone is between the swing high and the swing low. As we enter New York morning hours, we can see a huge sell-off coming out of London session, which is in the green box. We've already taken Asia low, and we're starting to move in such a direction that we can target previous day New York low. We'll denote that with the green line. As early morning hours start, let's play price forward to see what kind of price action we can observe. As we play price forward and zoom in a little bit, we can see that price approaches that key liquidity we had marked up and pulls away aggressively. This tells us that there could be some buyers here defending this zone. We'll continue playing price forward past the 930 open to see what kind of price action we see. After the 930 open, we get the liquidation of a previous New York session's low. And we also continue further down to take previous Asia session low, which is another key point of liquidity. At this point, I'd be interested to drop to the 1 minute to see if buyers can finally step in to change the order flow to be bullish in line with the 15-minute order flow. Here on the 1 minute, we can see the liquidation of those key points a little bit clearly. For me, I would be targeting this key level, denoted by the blue line, as the last area where sellers stepped in to aggressively move price down. We'll also notice that we're getting very close to the bottom end of the 15-minute low, which is supposed to be protected. I expect buyers to also step in as price approaches this area to help move it in alignment with the external order flow, which is bullish. These are all conflating factors that tell me that price has a reason to seek higher prices. But first, we need to see conviction from the buyers by closing above this line before I enter any trade. Let's play price forward to see what happens. A little after 10:30, we finally get that close above the blue line, which again was that last point where sellers stepped in with aggressive price action to move price lower. We'll notice that buyers have now closed above the blue line on the 1 minute and created significant fair value gaps along the way, showing us the speed and aggression that they're moving price higher. Let's go to the 5 minute to see if we can find a viable entry. Here on the 5 minute, we have two options. I particularly like the last sell to buy candle as an option here, since it would capture this bottom fair value gap and bring us into the second, more immediate fair value gap. It's an area that makes sense, which also helps us account for the large opportunity that we have here. We don't want to be too aggressive with our entry and risk the RR. We also don't want to be too conservative and potentially miss out on the trade. I'll place my entry at the top of that last sell to buy candle, and for a stop, place it right underneath this current New York low, which I expect to be protected given its proximity to the external low, which is supposed to be a strong protected low, as well as the fact that it's taking key liquidity and buy orders that should move price higher. As a take profit, I'll target previous day high that I've marked out here in red. Since this is a higher than normal RR that I'm used to, I'll likely take profits if I find myself in a winning trade. Let's play price action to see what happens. We'll notice that price enters a key zone here and immediately starts selling off to the point where we cut right through to our stop loss, resulting in a losing trade. Now, the interesting thing for me is that if we continue playing price out, we'll see that we were stopped out by just barely a few ticks before price eventually rallied in the expected direction, moving us into profit. While we do go back to our entry zone for more liquidity, we never really approach the stop loss area ever again before price moves up in our desired direction, ultimately hitting our take profit. This tells me that my thesis was correct, but the markets just weren't on my side since I got stopped out by very little down here. This is a key takeaway for me, not to take this as a loss that invalidates my strategy, but in fact confirmation that I was right in my bias, but perhaps on the wrong side of the market in this one-off case. The key lesson is this: a good loss is one where you follow your rules Because one trade doesn't define your hedge. Consistency does. And that's what I'm working on right now, separating outcomes from execution. Because being on the wrong side means you're on the wrong path. I'm not a guru. I'm just someone documenting my journey towards consistency, using market structure, liquidity, and price action analysis. If this breakdown helped you see the charts differently, then subscribe. And if you want to see another trade breakdown just like this, then check out this video right here. Every trade I take teaches me something different. And the next one might show you something you've never noticed on the charts before. I'll see you there.